Welcome everyone, and thanks so much for joining us for today's webinar. My name is Mary Ann Hensley, and I'm the Senior Vice President of Marketing for FreightWaves. And we are excited to be here and happy to present this monthly market update webinar in partnership with Convoy, which is dedicated to utilizing technology to bring reliability, transparency, insights, and efficiency to the trucking and supply chain industry. Today's market update is going to touch on the latest events affecting freight. And I think we can all agree that there have been quite a few changes since last month's session, so we're looking forward to that. We'll be hearing from Dean Croke, FreightWaves Chief Analytics Officer, as well as FreightWaves Chief Economist, Ibrahiim Bayaan. Before we get started, I'd like to cover just a couple of housekeeping items. First, if you have any issues during the webinar, please feel free to reach out to our team via the chat function on your Zoom control panel. Also, if you have any questions that you would like to ask our presenters, please enter those through the Q&A box in your control panel, and we'll answer as many of those as possible during the live audience Q&A after the presentation. We will also be sending a link to the recording of this webinar if you'd like to view it on demand or share it with your peers, so no need to record or take screenshots along the way. And at this point, I'd like to go ahead and turn it over to Dean Croke. Dean, since this is your first time joining us for this particular webinar, why don't you go ahead and just tell us a bit about yourself and your role here with FreightWaves.
Thanks, Mary Ann. Great to be with everybody. My name's Dean Croke, Chief Analytics Officer with FreightWaves. My experience is mostly in the commercial vehicle telematics space over a period of 20 years, originally from Fleet Risk Advisors, which became Omnitrax Analytics, which would be familiar to most of you, I think, in the industry. It was an offshoot of the Qualcomm Enterprise Solutions business. I've spent most of my time building predictive models and data analytics solutions for the trucking industry. And for the past year, been working in the FreightWaves business, helping us build out our Sonar platform and work with our data science team to build some very creative insights that are behind some of the Sonar charts that you're going to see today. So very pleased to be here, Marianne. We want to have a quick look at the agenda today. We're going to cover a few things today. There's a lot happened. We want to have probably a 5-minute update on the recent hurricanes, have a look at what's affected the markets there, have a little bit of a look at the holiday season outlook, look at some trends and capacities, and what's happening regionally. We're certainly in unprecedented times. There's some things happening in the freight markets right now that we haven't observed before. So we want to dig into those pretty quickly if we can. If you can move on to the next slide. I think you know Ibrahiim. He's comes now that we've done our 4th webinar. I think you all know him. I'm going to speak a little bit about the freight markets initially, and then Ibrahiim's going to come back and tell us about the broader economy and how that's affecting some of the different indices that we need to be watching over time. So a bit about who we are, just briefly to set the scene. FreightWaves, we're building a community to help companies analyze, react, forecast, and de-risk the freight market. We literally take in thousands of data points every day to understand trends and provide analytics to help freight market participants understand what's really happening in the freight market in near time. A little bit about behind the scenes of FreightWaves. We've got a brilliant editorial team who produce an amazing volume of content on the global economy every single day. It's a free subscription if you're not already subscribed. Online, FreightWaves readers spend 2.7 times more on our site than any other freight-related site. And each month we're getting around 1.5 million impressions, 12.5 million impressions, and 1.5 million page views. We also have deep domain expertise in key areas, including market logistics, economics, weather, freight markets, telematics, data science. And one of the things we really pride ourselves on is our core philosophy of combining data and tribal knowledge. Of course, data drives all of our market insights and editorial commentary, but when tribal knowledge is added, you begin to see things not easily observable. For us, it's a bit like using data to see in the dark when we integrate tribal knowledge, which is, of course, that unwritten information that is not commonly known, but more importantly, obtained from years of experience in freight markets. So let's dive into the weather update. I want to just cover very quickly a little bit of a recap on the hurricane season. Last webinar, you had Nick Austin, who's recently joined us. He spoke to you about what was happening with hurricanes in particular, and I think Michael was the last one he spoke about. I want to give you a quick recap on where they're at and how the overall hurricane season panned out. It certainly was a record-setting year. The oceans surrounding North America were really intense this year. when all the hurricanes in both Atlantic and Eastern Pacific Oceans were added together, we saw some of the most active seasons ever recorded. Florence and Michael were certainly the most destructive storms in the Atlantic, and in the Eastern Pacific, there were several powerhouse record-setting storms, including Lane, Rosa, and Sergio. We also saw some significant disruption in short sea shipping between the mainland and Hawaii. And for those of you in the freight space, the FMCSA still has some emergency declarations in force all the way through to November the 9th for carriers involved in emergency relief efforts. The DOT have a number of different websites you can go to at a state level to find out what particular regulations are you're exempt from, including hours of service and similar. So I'd suggest you go to your DOT sites to see what's still in effect in your areas. On to Hurricane Florence, it was certainly a devastating one, as you can see by the image there from outer space. Moody's estimate the cost of Florence at somewhere between 38 and 50 billion, which is mostly from building and vehicle damage, plus an amount for lost economic output. FEMA have made some grants to more than 40 counties for debris removal. The disaster relief effort is around 400 million. On the roads, there were some closures, but not nearly as bad as what we thought. There were some ramp closures and local road closures. The major impact on freight markets was, from our best guess, fairly limited. Many shippers that we spoke to moved their inventory in advance so that they weren't caught with a backorder situation in the busy season. We heard from a lot of truckers who moved to other markets if they weren't involved in relief efforts. If major roads were flooded, truck drivers we spoke to were able to find ways around the blocked roads and still haul the freight. But generally overall, the Hurricane Florence, from a freight market perspective, notwithstanding the excessive cost and loss of life, the overall impact on freight markets was minimal and localized from a truck carrier and shipper broker perspective. On the Michael, Moody's estimated the cost at somewhere between $15 and $21 billion in property damage. Recovery is progressing slowly, but there are still 27,000 people without power as of today. FEMA has started transitioning people out of shelters, but there are still tons of debris to be cleared on roadways. There's no major interstate closures, but there are some portions of state roads that are closed. And as of today, trucks involved in the relief effort are still having trouble with downed trees and power lines on roads. So the effect of Hurricane Michael was certainly very severe. We absorbed through a number of different news outlets a lot of fully laden trailers blown over on their side, which is kind of unprecedented when you think about the weight of those vehicles. So the damage to the trucking industry was significant to those carriers that couldn't get their trucks out of the way. If we could switch to the freight market update, we kind of think this might be the calm before the storm. We've got some mixed signals here. What we wanted to talk about was possibly a strong case for both bearish and bullish outlooks on the Q4 market, which we're going to go over today and present our case. Based on our sonar data, we're seeing the freight market show signs of slowing down as capacity increases and freight volumes decline across the board. This could be normal seasonality, but there are a few factors that we need to pay attention to, such as building inventory ahead of the January 1 tariff deadline, and how this might play out as the 2019 bid season begins, and possibly the pulling forward of the Chinese New Year order cycle that generally happens in early New Year that may well be happening now. We're also seeing inventories building. Inbound container volumes are at record level. The ISM index is up. So there's a number of things happening this quarter that we haven't seen before. And one index we wanted to sort of kick off the session with today is our market volume index. And it's certainly an interesting time for freight markets. And everyone, I think, at the moment is trying to guess whether peak freight is ahead of us or behind us. And if it's ahead of us, how severe a slowdown will it be when it occurs? The best data we've got is decidedly mixed, and we'll show you some data sets on both sides to give you a feel for where we think the market might go. There's the macroeconomic picture and what kind of outlook does it have for transport companies. We're going to address that question. And as you can see here from this particular index from our sonar platform, we can see that the outbound tender volume index, which is a measure of the volume in markets, this index was created in March with a base of 10,000. And the way to read the chart is that as load volumes increase, capacity tightens. And we can see that the volume is down slightly year over year at 9,700, but well off its June high at 11,080. So to the left of the chart, you can see last year's volumes. We can see that it's down. Certainly volumes have dropped early October, but they started to pick up a little bit, but they're down year on year. It's a little bit early to tell whether this is a seasonal factor or not, but there's a definite softening in the freight market from our perspective. There's some other things happening that will exacerbate this going into Q1 of next year, things like record levels of new truck orders, used truck prices remain strong, and the number of loads being rejected in the market, which is a measure of carrier activity, is falling faster than volume. So it's something to watch for really, really carefully. On the plus side, West Coast port volumes are up, container prices are coming up, so we expect that a lot of carriers will be in pretty good shape on the West Coast to pick up some of this early freight volume that might continue this typical busy season that we see in Q4 all the way right through to the end of the year, not just up until the holiday season. So we'll move on to the next slide, and I'll bring in Ibrahiim now to talk a little bit more about some of the macroeconomic picture before we dive back into some of the sonar data sets.
Good afternoon, everybody. I just kind of wanted to start by setting the table overall from a macroeconomic perspective for where the economy is as we head into the end of the year. So up here, I have just a chart of U.S. gross domestic product, which is the broadest measure of overall economic activity in the economy. And I have both the quarter-over-quarter growth rates and the year-over-year growth rates. The one thing I wanted to pull out of this, well, for one, is just how strong the second quarter of the year was. I mean, second quarter GDP growth came in right at 4.2%. That's one of the strongest quarters in this post-recession era. And there were a number of temporary things that helped make that that growth as strong as it was that we didn't see necessarily in the third quarter. So there was a big temporary boost in exports, in part driven by some tariff-related adjustments that businesses were making. Also, a tremendous surge in consumer spending in the second quarter that didn't quite grow at as rapid of a pace in the third quarter. And for that reason, I expect like the third quarter GDP numbers to come in a bit softer than what we saw in the second quarter. And you can see that the forecast is 3.2%. The actual numbers for GDP will be released tomorrow morning. And so, it'll no longer be a forecast. We'll see how accurate we are here. But I think most kind of expect that this number is going to come in quite a bit softer. Now, softer does not necessarily mean soft. I mean, 3.2% is still a really solid growth number from any kind of historical perspective. And certainly in this post-recession era, 3.2% is a really good quarter. I mean, if you didn't have this second quarter surge that we saw, then this 3.2% would be one of the more impressive quarters that we've seen over the past few years. And so I don't want to paint this picture that sort of activity has gone cold, but it's just not quite as robust as what we saw during the second quarter of the year. In year-over-year terms, for those of you that like myself, that like to look at comparisons to last year for planning purposes, the U.S. economy is just in a really good place. I expect year-over-year growth to be around 3% when the third quarter numbers come in. The fourth quarter should be around the same, about 3%. Growth year over year. Now, again, this is very good from any kind of historical perspective here. So some of the positives for the third quarter. The third quarter, again, consumer spending was very strong. I don't think it's going to come in quite as strong as it did in the second quarter, but still carrying a lot of the burden for the overall economy is strength in consumer spending. I mean, U.S. households right now, they're benefiting quite a bit from just healthy job growth, healthy income growth. And up until recently, rising stock market prices, which has helped boost overall consumer spending and kept consumer sentiment pretty high. And so I think in the third quarter, you'll see some continued strength on the consumer side of the economy. There should also be a big contribution from inventories, and we'll touch a little bit on that in a couple slides. But there's a general feeling that a lot of U.S. businesses are beginning to build up their inventories now, especially the kind of inventories that they import from other countries, in an effort to prepare for upcoming tariffs that are set to take place as we head into the beginning of next year. And then also other parts of the economy, solid quarters, I think, from government spending and business spending. Again, on the business spending side, like the business investment side, I don't think it's going to be as strong in the third quarter as it was in the second, but still solid nonetheless. And government spending, I think is going to see a bit of an uptick as well in the third quarter. The weaknesses in the third quarter, I think the biggest thing is there's going to be a big subtraction coming from the international trade. that over the course of the quarter, we saw just rising import volumes and struggling export volumes. And so that's going to have the overall effect of weighing down the overall GDP number. Housing has been one of the more disappointing areas of the economy throughout the course of the year, but particularly in the second and the third quarter. I don't expect to see any kind of gains in housing activity in the third quarter GDP numbers. And then if there's any potential hurricane impacts, that could also further weigh down the third quarter GDP numbers. Now, Dean mentioned earlier that the impact on overall freight markets from Hurricane Florence looked like it was fairly minimal, especially when you compare it to, say, the kind of hurricanes that we experienced last year with Hurricane Irma and Hurricane Harvey. I think comparably, there's going to be a much smaller impact from Hurricane Florence. But GDP may be 1/10 or 2% lower than it otherwise might be because of the hurricane activity. So just to look forward and to examine some of the key drivers of freight demand, I typically like to start with the industrial sector. I mean, it's one of the largest contributors to overall freight demand in the economy. And it's been one of the real bright spots throughout the course of the year. Here I have both total industrial production and manufacturing industrial production. The difference between the two is that total industrial production is also going to include all the mining production that goes on in the economy. And so that's one of the reasons why you see stronger growth coming out of the total industrial production number, is because mining activity has been doing fairly well this year. But in both cases, both total industrial production and manufacturing industrial production, you're looking at multi-year highs in terms of growth rates. I mean, total industrial production is growing over 5% right now, which is something that we haven't seen since really the early years of the recovery, like coming fresh out of the recession. The Federal Reserve did some estimates of how much they thought Hurricane Florence was impacting overall industrial production, and they also thought that the overall impact was pretty minimal. They said that Hurricane Florence subtracted about 1/10 of a percentage point from industrial activity for the month of September. The one thing I will note about these numbers is that I think the year-over-year growth numbers are going to start to get smaller going forward. The comparisons are going to begin to get an awful lot more difficult as we enter into October, November, and December, the beginning of next year. And so even if the industrial sector is still performing relatively well and moving forward at a solid pace, I still expect that the year-over-year growth rates are going to start to come down quite a bit, just because we're running out of sort of the easier comps to compare against. And this is something that's really the case with a lot of things in the macroeconomy, that over the past couple months and in upcoming months, you're going to start to see some of these growth rates moderate quite a bit from where they were. One of the keys to overall industrial production has been the strength of the mining and oil sector. Really there was a surge in oil prices that began in the middle part of 2017, after the big collapse at the end of 2014 and beginning parts of 2015. But this rebound in oil prices helped fuel an awful lot of investment in the oil and mining sector. And so all of these kind of fracking rigs that were shut down when oil prices went down, they opened back up and companies began drilling more. And that's fueled an awful lot of economic activity. We've said on a number of these kind of webinars, trying to emphasize how important the oil and energy sector has become to the U.S. economy. Whereas, say, 10 to 15 years ago, everybody thought of oil prices in terms of like what that did to U.S. consumers and businesses that had to use oil in the production process. Now it's much more about how much domestic oil production is going on in the economy, and how much that can actually help manufacturing and industrial activity. The one thing that I will say about oil prices is that they've stabilized quite a bit over the past few months. Now, part of this is being driven by just the fact that like the global growth outlook doesn't look as bright as it did a few months ago. And as you have like emerging markets in particular, as they struggle, that reduces the amount of demand for oil in the global economy, and that puts some downward pressure on price. And in fact, I think right now oil prices would be quite a bit lower than they otherwise would be, except there's some geopolitical things keeping the price of oil pretty high. There's the chaos that's going on in Venezuela right now, which is one of the world's major oil producers, that's kind of seen oil production drop off as their country just kind of descends into this chaos. But then there's also sanctions against Iran that's also restricting oil. And so that, these kind of geopolitical events are keeping the price of oil higher than they otherwise might be. Now, what's going to be interesting going forward is I don't really see like a major increase in the price of oil sort of on deck for 2019. And what that really means is it's going to be, just less incentive for another year of big investment in the oil and drilling sector. Like, I think as oil prices stabilize, you're going to find investment in the mining and drilling sector also stabilize. And that's going to remove one of the big kind of tailwinds that the U.S. economy has had over the past year as you look into 2019. And it's one of the factors that kind of lead me to believe that I think 2019 growth is going to be a bit slower than what we've seen so far in 2018. Shifting gears and taking a look at housing. Housing is one of the areas in the economy that you actually do see some hurricane impacts. I think overall, when you look at just like how the Hurricane Florence and even Hurricane Michael, how they affect the overall economy, like I think the impact's going to be minimal. But in housing is particularly sensitive to weather conditions. And so you can see right here, I have housing starts just from the South region, which is going to cover the Carolinas where Hurricane Florence hit. And you can see it dropped off significantly in September. In fact, it got as low, I mean, the last time it was lower than where it is right now was the last time there was a major hurricane that hit the South, which was when Hurricane Irma hit Florida. And so, just keep in mind that there's an awful lot of activity that's being derailed in the housing in terms of home construction in the South region. I think when the October numbers come in, there'll probably be some Hurricane Michael impacts there as well, again, in the South region. And what this really means is that there's going to be a lot of pent-up demand for housing housing activity going forward. Although there's a little bit of a question as to when that kind of gets unleashed on the economy. Because once you get past October and you get to like November and December, then you have to worry about like what winter weather is going to look like and how cold these months are. Again, housing activity is very sensitive to weather conditions. And so a mild winter might mean that you see that like quite a bit more housing starts activity November and December. But if it's a cold November, cold December, then you really don't see any kind of increase in housing until you get to the warmer months next year. Just thinking outside of all the hurricane fluctuations, I would say that housing has been disappointing even before that. Like long before Hurricane Florence hit, housing had been underperforming expectations. On the construction side, they have a couple of real bottlenecks. One is that they have a really difficult time finding qualified construction workers to build a lot of these houses. But the other thing is that there's just a real lack of developed lots that they can build on. And the combination of those two things is making it very expensive for builders to build houses, and it's restricting some of the housing activity. Now, these are problems that are going to persist even after all the hurricane fluctuations are through. There are going to be issues, I think, well into 2019. And housing is one of the areas that you keep an eye on for like an area of weakness.
Thanks, Ibrahiim. And following on from your indications about the housing market and how it affects some of those hurricane-affected areas, what we saw in mid-September was a dramatic fall-off in load tender rejections in the flatbed space, far quicker than any other space. So it kind of proves that flatbed is more susceptible to those sort of macroeconomic factors that you spoke about. The way to read this chart is that this is a chart that's a function of the number of loads tendered into market and the number that are rejected. So the way to read this is as the numbers come down, as the percentages on the right come down, capacity is increasing, and then there's downward pressure on price. So what we saw here in the flatbed space on that blue line that's more solid, you can see that in mid to late September, the number of rejections, load rejections in the flatbed space fell dramatically. That meant that carriers were less likely to go to the spot market and more likely to handle contracted freight. It was quite a dramatic fall off, and we were not sure about, this could be the early signs of a slowing economy because flatbed is so much tied to housing and construction, particularly flatbeds. Drop decks probably handle more machinery that's related to construction, but generally flatbeds are hauling a lot of material like like lumber and roofing tiles and general building materials associated with new starts. So that was one that really caught our attention. But what has also happened is there's been a gradual falling off of tender rejections have been falling off over that same period for all lengths of haul, for short, medium and long haul. So those other lines represent the short, medium and long haul sectors. They've all had a decreasing amount of tender rejections, which mean capacity's been increasing and there's downward pressure on price. But the notable exception has been refrigerated. And in refrigerated, it was almost inverse to flatbed over that same period of time, which is really interesting. In the refrigerated market, carriers seem to be less affected by rising interest rates and housing start data. And very generally speaking, consumers tend to buy more fresh produce and prepared protein when the economy is ticking along. So, that said, there are some strong pockets of strong activity around the country, such as the traditional icebox up in the Wisconsin area. About 40% of all butter gets shipped out of Wisconsin in November and December, so that's going to keep refrigerated pretty high in those Green Bay and Wisconsin and Minnesota markets. We know navel oranges and citrus are starting to come out of Florida, and the 9 factories in Yuma that's traditionally the winter salad bowl are starting to increase their production, which could ramp up some of the October activity and keep the demand for temperature control pretty high. The flatbed sector, just generally speaking, has had a really good year. They've had a fantastic year. It was a great time to be in trucking if you had a flatbed. Up until about August, spot rates were generally a little bit higher than contracted rates for most of the year. But we noticed they've started to fall off around the August period. And then what happened when some of those housing numbers started to come out and some concerns around tariffs started to bear out in the market, we saw a gradual falling off. Van freight was a little bit different. They haven't had such a good year. Most of these spot rates have been lower than contracted rates. So there's been evidence of increasing capacity in the van space. But reefers, there's still, refrigerated carriers had a pretty good year. Spot rates are starting to fall below contracted rates slightly, but there's some really good pockets where there's some good gains to be made for carriers if they're digging into some of our sonar indexes around specific key market areas. Next slide, Ibrahiim, we'll keep diving into some of the macro data.
Yeah, sure. So the next area I wanted to touch on was just retail, and particularly the retail outlook as we head towards the holiday season. I mean, the months of November and December are by far the strongest months for retailers. And so trends as we approach those months are going to play quite a bit into what the outlook looks like for them during their peak. So I wanted to start just by looking at the retail sales growth in the U.S. economy. This is just year-over-year change in retail spending overall. Retail overall, I think, has had a really robust year, but the year-over-year growth rates fell quite a bit in the September data. You can see there was a drop-off from above 6% in August all the way down to about 4.5% year-over-year in September. Now, I mean, a lot of people looked at the big fall-off and said, well, this is probably Hurricane Florence related. I don't really think so. I mean, most of the drop in September just came from like restaurant spending, and restaurants have had like just a tremendous year. I mean, even with the big drop off in September, their sales are up about 8% year over year. And so it could just be a breather on the restaurant side, not necessarily hurricane related. But the other piece of it is just like like other things, I think the comps are starting to get much more difficult for retail. That there was a big jump in retail spending last September, and so we had to kind of compare against a very difficult last year. And so that helped contribute to the big drop off in the year-over-year growth rates. Again, I don't think a whole lot of this is Hurricane Florence related. I also don't think that there's necessarily concerns about like the health of the retail sector, because the month-over-month change looked pretty positive in September, especially once you strip out the restaurant decline. But I just think as you go forward, I don't necessarily expect to see a return to these 6% year-over-year kind of growth rates that we saw in May, June, July, and August. And again, it's no real reflection on the momentum that the retail sector has. It's much more that just like the comparisons are getting much more difficult to last year, and so as a result, you'll see the year-over-year growth rates come down some. So for holiday sales, you know, I typically follow the same definition for holiday sales that the National Retail Federation follows, which is to take holiday sales, strip out auto sales, strip out restaurants, and strip out gasoline. And that's not because those aren't considered, you know, sort of holiday peak season types of purchases. And then I just look at like what the growth is expected to be. Right now, I'm expecting growth to come in a little bit under 5%. That's a little higher than say what the National Retail Federation and some other forecasters are calling for, but roughly in the same kind of ballpark in this somewhere between 4.5% to 5% growth year over year. I think consumers are just generally in a pretty good space headed into the holiday season. The job growth has been solid all year. You know, they got a bit of a disposable income boost because they got you know, households got a tax cut at the start of the year that's been carrying over. And confidence is very, very high as you head in towards the end of the year. So all of this kind of points towards a consumer that's ready to spend and has the means to spend. The caveat to that has been the recent decline in the stock market. Like I'm really curious to see how that plays out in the confidence and how deep the kind of stock slide goes. You know, yesterday was another big decline. Like it fell over 3%. The S&P 500 fell over 3% yesterday, and that was enough to wipe out like all of the gains for the entire year in the stock market. The market bounced back a little bit today. Like I think it's up over 1% so far today, so that's good news. But I mean, that could just be a breather in what's a more prolonged kind of slump for the stock market. And you know, if households start to see that the value of their portfolios is going down, that could turn around and affect how they feel about spending headed into the holiday season. And so I'm just kind of in a bit of a wait and see mode to see how deep this stock slide goes. There's definitely some downside risk if it gets significantly worse. But outside of that, I think consumers are probably in a pretty good space here. You know, a couple things about this holiday season. You know, what I typically like to look at is like how long the holiday season is. So how long is that period from Thanksgiving to Christmas? Like how many days do people have to shop? For one, that influences the total amount that people buy, but it also influences like the time that shippers have to get things from point A to point B. When you have these really, really compressed holiday seasons where Thanksgiving is particularly late in November, what it means is that deadlines get tighter. It's much tougher to satisfy like the overall consumer demand in a much shorter time frame. This isn't one of those years where Thanksgiving is particularly late. In fact, it looks very similar to last year. I don't think there's going to be a whole lot of fluctuations due to the calendar overall. Although, you know, and so I think it's reasonable to expect growth that's roughly the same as what it was last year. Now, one of the other trends that's going to continue to play out during this holiday season has been the strength of e-commerce. I don't think it's any secret to anybody here that an increasing share of retail purchases goes through e-commerce channels. That consumers are, number one, consumers are getting more familiar with how to buy things online. It's getting easier to make purchases through your phone or in other ways to avoid having to go to a store. But also, you know, retailers are getting better at e-commerce as well. For things that they've traditionally sold through e-commerce, you know, they're finding better ways to interact with customers. But they're also opening up new products for sale through online, like categories of retail that weren't necessarily exposed to e-commerce are just, you know, shippers, businesses and retailers that are finding creative ways to find ways to allow consumers to purchase these things online. And I think this trend continues this year. E-commerce growth in general has been very strong throughout the course of the year. And you know, there's not a whole lot of signs of things slowing down in any meaningful way. This chart here I have here is what's called electronic shopping and mail order retail sales. This is a subcomponent of retail spending. It's not exactly the same as e-commerce spending, because for one, it includes mail order, which is like catalog sales, and people don't do a lot of catalog sales anymore. But the other thing is there's a good amount of e-commerce spending that takes place outside of the channel and falls under the e-commerce banner. The one thing I'll say about this electronic shopping and mail order metric is that it's it's one of the few monthly metrics you get of how online performance is doing. And you can see some slight moderation. Like it was growing about between 10 and 11% earlier this year. It's down a little bit below 10%, but still very strong e-commerce trends year over year as you head into the holiday season. Again, I expect that this kind of trend continues. You should still see double-digit growth in this, somewhere around double-digit growth in electronic shopping and mail order sales. So for actual e-commerce sales, you can see that, again, the growth rates. For one, the growth rates are significantly higher, but they tend to generally follow the same kind of pattern as the electronic shopping and mail order sales. So the last actual data point we have is from the second quarter, which was above 15% growth. I expect a little bit softer numbers when the third quarter numbers are released next month, and then a bit better performance in the fourth quarter, like close to 16% growth year over year in e-commerce spending. You know, that's going to be enough to make up over 10% of all retail sales for the fourth quarter. Now, 10% doesn't sound like a whole lot, but consider that there's still like big chunks of retail, like car sales and things like that people almost never buy online. If you strip out those kind of like categories like groceries and auto sales and things like that, e-commerce makes up over somewhere around 20% of just like all the shopping that goes on in the U.S. economy. So, shifting gears a little bit and taking a look at trade performance. Trade is another one of the things that I consider one of the key drivers of freight movements. And there's been an awful lot of noise in the trade data over the past several months. I have up here goods exports growth year over year. And you can see that there was a tremendous surge in export growth. It got above 13% in the middle part of the year before starting to decelerate. Now, most of this is, or at least a good chunk of this is just tariff-related kind of shifts that businesses were making. Like during the second quarter of the year, a lot of Chinese customers who import U.S. agricultural products began importing them ahead of schedule in an effort to try to avoid some of the tariffs that were being put into place in June and July. And what happened as a result is, you know, you get this surge in export growth in May, June, and July before you start to see some of the payback. Exports declined in the previous 3 months. There was some export numbers that came out a couple hours ago that were a little bit better, but still the growth rates look closer to 8% instead of the double-digit kind of growth that we saw in the second quarter of the year. A similar sort of thing is happening right now with imports, I believe, in that you're starting to see U.S. businesses that typically import things from China beginning to import more than they normally would right now and just storing it in their inventories. Now, what this means is that, you know, as you get to the other side of some of these tariffs being implemented, there's probably going to be a drop-off in import volume as well, that you're getting this kind of pre-tariff surge before you get a post-tariff kind of drop-off in import performance. Now, on the tariff side, like the trade policy picture has been a little bit mixed. You know, we had some good news in that the U.S. reached a deal with both Canada and Mexico on this kind of post-NAFTA replacement trade deal that kept most of the things from NAFTA in place, so you don't get a whole lot of disruptions there. But I think things with China have definitely deteriorated. Negotiations between the two countries, I would say, they've just kind of stalled. They haven't been able to make any real progress. The U.S. has gone ahead as scheduled with some of the tariffs that they had implemented, and there's another big tariff date coming in the beginning part of 2019. At the start of the year, a lot of the things that have 10% tariffs on them right now are scheduled to ramp up to 25% tariffs on them. And so, again, this is part of the reason why I think that there's an awful lot of import volume right now, because they're trying to get things in before January, before you get this ramp up to 25% tariffs. And so just an awful lot of noise here that's masking some of the fundamentals. Now, there are some kind of actual macroeconomic forces that are at play here as well. For one, global growth, I think, is looking a bit weaker than it did earlier this year. Starting to see some cracks in terms of growth coming out of China. Europe looks like it's slowing down some as we approach like the Brexit deadlines without any solid deal in place. And so the global growth perspective doesn't look great, which makes it difficult for U.S. exports. And then at the same time, the U.S. dollar has gotten a bit stronger over the past few months. And again, that also discourages exports. Like the stronger the dollar gets, the less people want to buy of U.S. goods. And the more, U.S. customers want to buy of foreign goods. Like it makes foreign goods comparatively cheaper and makes U.S. made goods comparatively more expensive. So there are some fundamentals at play, but it's a little bit difficult to see through all the tariff-related kind of fluctuations to see what the impact of those things are.
Yeah, thanks, Ibrahiim. Following on from the tariff comment you made earlier there, it's clear to us when we look at the Baltic Index, which is an indication on the chart there of the China to North America West Coast and East Coast container prices. You can see since April, prices have been going up fairly steadily, although even though they're coming off slightly to the East Coast, they're still ramping up on the West Coast. And clearly there's a tidal wave of containers headed to the West Coast, which is going to have some implications on Q1 volumes for all modes of transport. Normally the customarily the fall freight surge never really materialized this year because we've got some government interventions here that are impacting the normal freight market. Instead of the normal drop off in demand that we normally see, a lot of freight volumes were pushed forward to avoid the tariffs. And if you look at where the rise started, the first tariffs came in on July 6th, and you can see that ahead of that in April, prices started to increase. Same around September 4, and then there's the next push towards January 1st, 2019. In fact, June's volumes this year were larger than May's, as a lot of those Chinese shippers that Ibrahiim mentioned moved their freight ahead of the deadline. And that pushed up those volumes in September much higher. Some of the carriers that we've been talking to are telling us that some of them are paying double what they would normally have paid for on fixed contracts. So, some carriers had fixed contracts at $1,100 to $1,200 for a 20-foot container. They're paying double that now as they try to find space and rates to get their freight moved ahead of the tariffs. So there's definitely an impact on rates going on. The problem is, I think, that a lot of the freight coming in from now and sort of November and December won't be time sensitive, and it's literally just going to fill up in warehouses as inventory, as Ibrahiim mentioned. So that's going to have a big impact on on freight volumes early in the new year, immediately after January 1. And that's going to have, I think, a pretty big impact on carriers, brokers, and shippers as everybody starts to figure out what the 2019 bid cycle looks like and what sort of rates will be plugged into the various route guides. That's one thing we're seeing on container price movements is the price is kind of a measure of the volume that's heading towards us. And our feeling is that a lot of that is sort of been driven by the forward ordering of inventory to avoid the tariffs, which kind of caught people by surprise too when it went from 10 to 25% later this year. To support that, the other index I just wanted to share with you quickly is the tender market share, which is kind of it's a representation of the amount of load tenders in the market at a key market area level. And this is Los Angeles. And what you can see here is that the tender market share is increasing on the dark blue line out of Los Angeles, which is an indication that capacity is decreasing, which means rates should be pretty good for carriers out of that area. And the top line is a replication of the price from the previous slide. So you can see that over the course of this year, the tender index out of Los Angeles has been favorable for carriers. It's been gradually increasing over the last 6 to 8 months, much the same as the prices have increased. But what we'd be watching for carriers, shippers, and brokers out there would be for some sort of a drop-off in this towards the early part of next year. That's something to watch through the sonar ticker. We also think that normal bump in the new year around Chinese New Year freight, that may well be arriving early before the tariff season. So we need to watch that to see which is seasonal and which is impacted by the tariffs.
Okay, so most of what we've been discussing so far has been focused on just like freight demand and what are the key drivers of freight demand and how they've been performing. I wanted to shift gears a little bit and start talking about the capacity side of things, how freight capacity looks over the past couple of months and where we see it headed going forward. I don't think it's any secret that one of the bigger bottlenecks on the freight supply side has been just the lack of available drivers. And so I keep a pretty close tab on how hires are going within the trucking industry from month to month. September was another positive month for trucking hires, even though the overall hiring numbers, like the job growth for the overall economy, fell quite a bit in September. But trucking hires kept on moving in a positive direction. When you look at just sort of the trends in trucking hiring, the trucking industry is adding workers at a faster pace than the overall economy, which is certainly a good sign in terms of like adding enough capacity to begin to keep up with all the freight demand that's out there. Most notably, this 2.2% pace of growth in trucking employment, that's faster than the pace of growth of manufacturing jobs in the economy, which hasn't been the case all year. But now that this idea that the trucking industry is adding more work or adding workers at a faster pace than one of the bigger drivers of freight activity is a sign that capacity is starting to gain some positive ground. I still think the lack of drivers is one of the bigger bottlenecks. I think we're probably a ways away from resolving just sort of this idea of a driver shortage, but I do think things have been getting better. When you look at some of the survey data coming out from manufacturers, like if you pay attention to the Institute of Supply Management index, earlier in the year, I mean, there were an awful lot of just individual respondents that said like, we're producing enough, we have enough demand for the stuff that we want, and we're meeting our production targets, but we can't find enough available drivers to get things from point A to point B. Or they'd be saying, we would love to produce more, but we can't get our supplies into our plants in time in order to execute all the production that we need to execute. Those kind of responses, I think, have quieted down a bit. In the last manufacturing ISM report, there was very little mention of just like trucking capacity as being one of the bottlenecks in the overall manufacturing process. And so I take that as just like an anecdotal kind of piece of evidence that capacity is starting to catch up, and it's becoming less of a pressure point for manufacturers than it was earlier this year. Now, again, part of this is because hiring is improving, but I also think that a lot of shippers have just reevaluated how they move freight around, and so in response to the lack of available truck drivers, they've investigated ways to move things via rail or via intermodal that don't have the same kind of capacity crunch necessarily. And so the combination of just like more capacity being added in trucking, combined with just shippers finding ways to be more efficient with the way that they move things around, is making it less of an issue, not quite as tight as it was earlier this year.
Yeah, and following on from that line of thought, one of our views is that the market is definitely softening, and one of those ways we measure that is through driver productivity and our hours of service ticker in Sonar. One of the things we measure is the number of hours drivers drive on their line 3 of their logbook, which is classified as on-duty driving. And if you look at our chart, you can see that when the ELD mandate came in late December, you can see a definite uptick in hours. This was literally just the hours drivers were recording started to get recorded via telematics. The hard mandate came in around early April, and you can see a bit of an uptick there in the green line. 4th of July, Labor Day, you can see drop-offs. But what you notice from the peak in June, when the freight markets were at their peak and capacity was sort of at its lowest, when we look at the capacity index, you can see that it's gradually tapering off. It's not significant, but there definitely is a downward trend in the number of hours drivers are driving each day. So that sort of supports our theory that capacity is increasing as the number of hours drivers are working sort of decreases over time. This is a really good index of driver productivity and how the market reacts to the changes in the regulatory market. We think that with the changes the FMCSA are making or proposing to make, and let's hope they finally go through this, I'm really pleased that they've gone out and spent some time talking to truck operators in some pretty hot spaces like the recent Guilt by Association truck show in October, where they went out and literally sat with a bunch of owner-operators in fleets and talked about hours of service, you know, and I've never seen that happen. I've never seen the FMCSA go out and actually openly solicit support in some really tough areas where they're open to criticism. So kudos to the FMCSA for doing that. Some of the things they're proposing around the split sleeper berth rule, dropping the 30-minute rest break, doing some creative things around how drivers put their 10-hour break together. If those things come off, we can see a positive impact on capacity somewhere in the 5 to 6% range, could be as high as 10%. We know that from our modelling that drivers who have more flexible hours of service, when we've modelled it, if you can be more flexible about how you put your 11 and 10 together, you can run about 10% more miles per week. So we think there's a significant delta here if we can get the FMCSA to move on this. It'll boost productivity in the market. It'll improve the amount of capacity. We should have an effect on the driver retention, turnover and pay issues. So lots of benefits from this proposed change. We need to all support that one. The other one that's kind of supporting our theory that there's still a little bit of capacity increasing in the market to a degree, used truck prices. I think there's a bit of a cautionary warning sign here. We're seeing that prices for used trucks have increased over the course of this year. If you want to jump to the next slide, you can see that since January, prices have been gradually increasing for 3-, 4- and 5-year-old trucks, which is, you know, used truck prices are an indicator of overall market health. One of the warning signs that we're watching for is sort of the OEMs have indicated they've had some production constraints. They're starting to ease. So what we're watching for as the record levels of Class 8 trucks start to roll off the production lines in increasing levels, what we're watching for are higher levels of trade-in volumes, which could adversely impact the used truck price in Q4 and into Q1 19. So we're watching very carefully how this changes week to week, because we're looking for that turn once the rush of trade-in volumes hits from fleets taking on their new orders as they get delivered. So another one to watch in Sonar, the 3-, 4- and 5-year-old trucks.
So, I mean, taken overall, I think when you think about like what the demand conditions look like and what we think is happening with capacity, I mean, it certainly points to an environment that's not quite as tight as it was earlier this year. And so that means that, you know, I still think that trucking overall is pretty tight, and there's going to be some upward pressure on price, but I don't think that the rate of growth in trucking rates is going to be as high as it was, say, in the second quarter of the year. So here I have just the producer price index for long distance truckload freight, which is a measure of just overall prices that producers receive for this industry. And you can see, I mean, there was a surge in trucking in rate inflation in the industry. It reached about 10% a couple months ago, but it's come down over the past couple of months. Now, you know, I've said this a bunch over the course of this webinar, but a lot of this is really just tougher comparisons to last year. That there were big jumps in freight pricing back in August of last year, and again in October and November of last year. And so as we come up against those kind of comparisons, you're going to start to see the year-over-year growth rates come down some. Like it would take just massive increases month to month in order to keep up with some of the growth that we saw over the course of last year. And so, you know, a lot of the reason why the growth rate has come down from about 10% to a little over 7% is really just tougher comps. I don't think that there was a whole lot of evidence of any hurricane-related surges as it relates to trucking like there was last year. Again, this kind of goes with the idea that I think the hurricanes overall had a smaller impact to the overall economy than say Hurricane Harvey and Hurricane Irma last year. And so I think going forward, it's probably reasonable to expect that this moderating trend is going to continue in upcoming months. Like I expect to see year-over-year rate inflation come down to the 5 to 6% range, away from this kind of double-digit record high range that we saw earlier this year. Again, a lot of this is tougher comps, but then the other piece of it is just you have gradually easing demand and some improved capacity in the market, which is going to lead to just less price pressure overall here. So, just to wrap everything up, I think demand conditions look generally solid. Again, it's not going to be as strong as the second quarter of the year. I think when the GDP numbers come out tomorrow, you'll see something softer, but not weak by any definition. Still, I think pretty strong demand growth when you look at the big sectors. There are pockets of weakness within freight demand. I mentioned housing as one of the areas of weakness. And then there's going to be some fluctuations as it relates to trade. So, anybody that's involved with import or export movements is going to feel some surges and drop-offs as all those tariff-related fluctuations work themselves through. But I think overall demand looks pretty small. Looks pretty solid. I think the hurricane impacts look to be relatively small. And then trucking capacity, on the capacity side, I think capacity is continuing to expand, which is easing some of the pressure in the overall market.
Awesome. Thank you so much to Dean and Ibrahiim for sharing your insights with us. And we do have just a few minutes here for some questions that have come through. If you do have a question and we do not get to it, we will be sure to follow up with you after this session. So feel free to send those along as they come to you. The first question is really around the midterm elections. So based on historical data, how do you see the midterms factoring into the markets?
Yeah, I mean, there's been quite a bit of research around how the economy performs around election time, and there hasn't been anything conclusive to say one way or another that elections either disrupt or boost activity. Now, with that said, I mean, each election is a bit different from the previous one. I think there's a pretty clear evidence that the economy and markets and confidence surged in the aftermath of the 2016 presidential election. But as far as the midterms are concerned, I think if the Republicans kind of maintain control of both the House and the Senate, I don't expect anything big. Partially because I don't think there's any real clear-cut agenda for things that they want to push forward. They haven't really decided. There was some mention over the last week that there's going to be a mysterious middle-class tax cut that's in the works here. But there haven't been any details, and I think it caught most of these congressmen off guard, just like it did everybody else. So I don't really know what to make of any of that, and I don't think the markets will either. But they haven't. There's no kind of clear platform that the Republicans are looking to enact if they do manage to keep control of the House and the Senate. Now, the reverse is, if they don't, if the Democrats capture the House or they capture the Senate. Again, I don't see a whole lot of anything major happening. I mean, as long as they don't have the presidency, you don't see any major reversals in any kind of proposals. And if anything, it might bring some stability to have a stronger check against some of the rhetoric that's been coming out of the administration over the past couple of months.
Great. And the next question, where do you see exports falling, and are you able to identify which regions those declines might affect? So,
U.S. exports, I think. So yes, you can see the destinations where U.S. exports go, and where what countries are being affected, and I think the obvious answer in the data has been the exports that we have to China. Again, a lot of what's been going on with exports is really just Chinese agricultural imports of U.S. agricultural products, and so you can see it both in the kind of stuff that we're exporting and the countries that we're exporting to, that you see the export fall off. On the import side, I think it's the same. Right now, I mean, in my mind, most of the tariff-related concerns they're almost all connected with China. I mean, unless you're in the auto industry or one of these downstream steel industries, you're still worried about the steel and aluminum tariffs. Most people are really just concerned with how relations with China are going, and so that's where you're going to see most of the fluctuations and the disruptions here.
Great. And then I think we've got time for maybe one more. Do you see a crash in freight prices once the tariffs take effect? And if companies have excess inventory on hand, they would not need to import for quite a while. I think that was just a comment.
Well, right. I mean, I do think there's going to be some downward pressure here as you get to the other side of these tariffs for exactly that reason. That if you follow the logic that there's a lot of companies that are importing now so that they can avoid the tariffs, then once you get to the other side and the tariffs are in place, some of these companies are prepared and they no longer have to import. So you'll see a pretty significant drop off there. I wouldn't go so far as to say that's enough to cause like a collapse in prices overall for overall freight, but I think definitely in certain aspects of freight, like certain lanes, certain types of things of freight that get moved around, you're going to see quite a bit of downward pressure on prices there as this kind of takes hold here.
Great. Well, everyone, that is all of the time that we have for today. So thanks to you for listening in and engaging with us with your questions. And thanks again to Dean and Ibrahiim for sharing your insights with us today. Stay tuned for the date for next month's webinar. And if you haven't already, go ahead and purchase your tickets for MarketWaves 18, which will be in Grapevine, Texas, here in just a few weeks on November 12th and 13th. MarketWaves is the premier event for the freight industry and will include an incredible lineup of speakers, live product demos, some awards, and a great after party sponsored by Uber Freight. Tickets normally go for $24.95 each, but we are offering a special right now for $12.95 each. So if you'd like to join us, visit marketwaves18.com and use the code FALLISHERE promo when registering. So thanks again for joining us today, and thank you again to Convoy for sponsoring this monthly market update. We'll see you again next month.